Welcome to the Commercial Real Estate Podcast powered by First National. I'm Aaron Cameron. With me, of course, Adam Pawlik. We're recording live here at the Canadian Apartment Investment Conference. We've got a returning guest, one of our favorites, and always a very interesting conversation just because of his scope and where he kind of sits in the commercial real estate world. We've got Peter Senst, who's the president of the Canadian Capital Markets team at CBRE. Peter, thanks for coming back on.
Absolutely a pleasure to be back. Nice to see you both.
Well, this is, I think, third appearance. So if you want to put it on your LinkedIn profile now, I think regular is the term we would use for you at this point.
Put that right under president. I mean, if you want to put it on your signature of your email, it's totally fine. You have our support. All right. So Peter, there's lots of different things to talk about. I think first, let's just go backwards. How is CBRE? How is your business going at CBRE?
Yeah, very interesting. So we've had, for the whole industry, not even just CBRE, it's been a challenging 5 years. So we always talk about real estate as a cyclical business. Well, this is something now where we've been through the tough times. It just seems like things are changing. We're seeing it live in bid response. The conversations we're having with local, national, and global players, it's just elevating. It's feeling a little bit better. And I think it's in anticipation of rate cuts. So if we dial back the last couple of years, rates run, valuations of real estate goes down. For 35 years, I've seen only one thing. Rates go down, values go up. The more money you put into real estate, the more money you make. That's
how it works, right?
That's all it is. So we were the favorite child as real estate. So as the investable universe, real estate made everybody a lot of money. All of a sudden, it changed. And that's the psychological impact where all of these big institutional players are saying, I want less real estate right now. Let's wind things down a little bit. Let's go in a different direction. What used to be a core strategy, now it's shifting to value add core plus, infrastructure, other asset classes are taking the money. But with rates coming down, I think we're at the front end of seeing a shift. We're going to see money come back to real estate. You're going to see institutional players follow the high net worth, some of the global players, some of the bigger, interesting deals that we've done recently. You're going to see the institutions come back and go, okay, we're missing out on that. We should do that. Public markets, all-time highs. You look at some of these other asset classes, they're getting a little bit riskier. It's always going to be like this. So we're seeing that in the asset classes right now. So it's fascinating. Like office was as good as it could ever be. Then it wasn't. Now it's coming back. What's really making our firm stand up right now and take notice from a revenue perspective is all the office leasing revenue. And this is, again, a local and national and global story. So this is synchronized around the world. And I just feel better. Like after some challenging years, 26 starts to look a lot more positive.
Stay in the mix till 26. That was always
I might write that down. Thank you.
Yeah, we stay alive to 25, missed by about a year, I guess. I mean, if nothing, real estate people are traditionally very optimistic. Mm-hmm. But I guess you're calling this is the start of the next cycle, and interest rates will be the tinder that gets that fire going.
Well, if you look at our share price, a lot of people are playing a slow global recovery in real estate through companies like ours. So we're in more than 100 countries. We're a market cap of greater than $50 billion. We'd have the largest development company in North America. We'd have about 170 billion under management. Like we've got a lot of really big parts of the company. We'd be the largest property manager in the world. We're seeing what's working. We're seeing what's not. But it's feeling like it's going in this better direction. So for us, again, with the dashboards that we've got and all the information we get to look at every day, it's just improving. So as a patient, it's starting to look better.
How do you internalize sort of include in your calculations just the impact of the tariffs and sort of the geopolitical risk that we've got? Yeah. We were talking on the way over here. Canada for the longest time, low yielding but super safe. Like you were able to kind of park your money and not worry about it. That's not the same story today in 2025 as it has been.
Yeah, so we're taking that all in stride, and we just heard Ben Tall talk about that this morning. Like tariffs are going to move up. It's going to be a little bit tricky, but it's certainly going to be manageable at the same time. The U.S. can't come in too hard, do too much to its closest trading ally. So is it perfect? No. Can we manage it? Yes. We're now through that worst case scenario. So we're February 17th. That was all announced. We were all shocked and all of our trading stopped. Q4 of 2024 was our best quarter ever for revenues as a firm. January for the Canadian business was incredibly strong, and then February it all came apart. But it came apart for about 3 or 4 months only. Now we're back into that positivity in the trading patterns. Here's one of the adverse reactions to that. Now we're getting a lot of European and other capital saying, you know what, we don't necessarily want more US exposure right now. We'd like to have a little more Canadian. So
Yeah, you want to be in North America. You're worried about the
take
U.S.
head
Where does
here,
it go?
Right? Because with all the stuff going on in the U.S., a lot of people would just say this can't end well. Like this is take on the whole world. And I just think that again, Canada's a bit of a safer bet. I would always call us a great beta bet. At the bottom of cycles, we outperform. At the top, there's not the alpha that you get in the U.S. They lever up, they build more, they do things in a little more exciting way. Think of us more still as a bond type product. I think this is going to be something where it starts to soften, starts to feel better, and I think Canada will rebound, but it is a tough topic right now.
But you don't see that bloodbath at the lows that you do in the States. Everybody's largely still in business the year after a bad event.
Well, the confidence just falls out. The floor just goes because they're all in. And when things go, it really goes. And when you don't have to stand behind your mortgage commitments like we do here, they'll just let the mortgage go. Everything can really drop.
They're very good at ripping the Band-Aid off and just in our world, you look at the CMBS market, the commercial mortgage-backed security market, never came back in Canada. We were all kind of a bit too, not afraid, but it just, too tepid. In the US,
it was a fender bender here for us. In the States, it was a car crash, and they were enthusiastically back in 18 months later.
Yeah, that's that when it all it's just they compete to a different level than we do. It's clear and evident.
So let's go around the horn a little bit.
Can we start with, I got one I want to start with.
Okay, go.
So we've been hearing from a variety of different sources, offices picking up, on the leasing side, which then should translate into more investment activity. That obviously be great for brokers' business because historically, office has been the trophy assets. And I speculated on the walk over here, and I want you to confirm, of the 5 largest deals you ever did, how many were office towers?
A lot of them. And I think if you take that to the owners, their positions would have always been number one office. So when I grew up in this industry, it was all about office. It grew into malls. Like once upon a time, if you wanted to be the top of the return threshold, you had to have malls and big office. But it's a reminder that everything cycles, everything's always changing. And you've got to have that forward looking radar to say, okay, there's a couple of flashing lights on the dashboard warning, can you move positions? And these are tough positions to move. Like they're big, right? And you build a whole company around it. So it's tricky, but we have to be more nimble. We have to be more thoughtful around it. But when you come back to office, what stands out clearly to us today, our August revenues. So here we are just coming in, we're at the beginning of September. We're up 40% for the month of August versus that time last year. Like it's palpable. It's different. I'm seeing a skip in the step of our leasing people. It's a bifurcated market. So this is the best buildings taking the best tenants. Rents are now moving in a way that's surprising even us. So JP Morgan just took the top 2 floors at CIBC Square, top rents we've ever seen in this country. So again, it's your groups are making statements. The banks are all saying, okay, we want more space. We need more space. We're calling people back 4 to 5 days. We don't have the space. They gave it all up during COVID. And with that being the case, now they got to play makeup. So they're going to pay up. They're going to do things differently. And I think for productivity, like one of the things we talked about this morning on the panel was just productivity in Canada hasn't been great. And when you're working from home, I don't think that helps. Around the world, people are in the office. Around the world, people don't have the ability to say, you know what, I think I'd rather work from my couch.
I'm gonna put an anecdotal story, but I think it's a kind of a uniquely Toronto story too, to some degree. I was at a soccer practice with my kids, talking to some parents, the other fathers who are successful, business people, talking about how their corporations are forcing them back to the office, and they were kind of reluctant. And I said, yeah, but it's really good. I love being in the office. I'm in the office all the time, and they were very reluctant. They're like, yeah, but then I can't go and cut my grass, and I can't go and run and go to the grocery store. I can't do a load of laundry in between meetings. Like it was just they were laughing, acknowledging their sort of counterintuitiveness, right? But that is, I think, somehow embedded into our psyche. Like it's okay to work from home and do all these things at the same time.
It's a sense of entitlement.
Yeah.
And it just can't work. And a lot of the groups, like when we represent some of the banks and some of the bigger important firms, and their employees will say, but we can't commute in, like all the bike lanes, it's surprising how difficult some of the moves we make as a city impacts all of this. So it's all linked. There's probably some kind of algorithm between bike lanes and and highway construction and everything else, just to make it more difficult to get in. An average commute now, I remember our London people, our New York people would all complain, it's an hour and a half, and I'd be laughing, like come in from Oakville, it's 30 minutes. Well, that's now probably 75 minutes. So we're making it tougher on ourselves, but productivity as Canadians, we need to get back into it. We need to be driving it. We need to be in the office space. So it's, we're seeing so much just renewed interest. And again, it's going to be the top buildings now, the best of the best, vacancies pushing through 5. The overall rates are still in that 20 zone, but that's coming down too. You're going to see this. This will be a contagion where if your competitors are going back into the office, you got to do it as well. So this is going to be something where it's going to have a bigger impact. I think we're going in a better direction. And you watch, I will suggest before June, you hear an announcement. So this will be June 26th of the next tower being built. So there's discussions I know going on right now, buildings being pitched. Somebody's going to get a great tenant. Somebody's going to say, we're going. And that'll be shock and awe again to everybody.
We want to lease up in the lull that will be created. I also am very respectful of people that will put out predictions with a date on it. So I like that you didn't say, sometime soon, that you said, no, here's when it's going to happen.
Yeah.
Which asset class? You can
I was going to say, that's probably the rosiest story.
After being a bad story for so long.
Yeah, right. And really, it's just, it's snapped back, right? Like it's gone from just sort of like the ugly sister in the real estate community to all of a sudden being the centerpiece. We're at the Canadian Apartment Investment Conference. Maybe let's save apartments for last, because that's also an interesting conversation. Both industrial and retail seem to just be steady right now.
Resilience, I would say, for industrials, the word that would come to mind for me. We're still trading. But here's the reality. New build rents have gone from $22 to $18. So that's a real dent. So everybody who likes real estate because of the cash flow growth, well, some of these asset classes, you're seeing rent decline. So that's the challenge. So how do you price that? So if you're dealing with a great building, but it's got $22 rents, you got to rationalize how you're going to grow that, how you're going to value that.
With office, being challenged for so many years, was some of the institutional capital moving into industrial? Because it's never really been a big institutional attractive asset class.
Sell down office, sell down malls, let's go apartments, let's go industrial. So that's been the trade. But the biggest shift now is food anchored retail. I can't say that loud enough that everybody wants some of that at this time. So for every 10 calls I get from investors saying, can you find me this? Can we do that? What do you think of this? It's now on food anchored, and it's because it's offensive and defensive at the same time. So nobody's building any. So if you look at sort of the universe, I'd probably say there's nothing being built in any asset class right now, like nothing new. So we'll finish all that purpose-built rental and condos. But right now, if you're a food store, to make an economic rent pencil for a development, the rents are just shocking. Like you're talking about rents that they just do one of these and they struggle with. So this is all going to be, what do we do going forward? How do we grow our businesses? So that's what they're all working on.
Yeah, how does that impact the rents in the retail space? Like, do you just find that that's going to just keep going up, right? There's just no new supply.
If you want a prime food anchored box as a retailer, you're now talking about, like, once upon a time, those were $8 to $15, maybe even less. That's going to jump to 30, 40. It's just going to keep going in that kind of direction. So again, your margins get squeezed. So that means going to have to charge more for the food. We're going to charge more for a lot of things. So that's going to be one of the challenges.
Should we jump into our favorite asset class?
Sure.
So we are at the apartment conference. Yep. It's funny, this conference 2 years ago, or any conference 2 years ago, beds and sheds. Everybody's excited about both. Growth curves and rents were enormous for both. Apartments also have rents coming off. The promise of perpetual NOI growth is not present in apartments right now. Still a favorite asset class for sure. But what are you seeing in terms of investor sentiment at that, at the high level?
Yeah. Well, the shock and awe really came a couple of years ago when rates spiked. So rates go up, values come down. And again, we'd only seen values going up for decades. So now you've got, instead of cash flow growth, you've got declines in your cash flow.
And cap rate decompression.
Well, yeah, so that cash flow stream's not worth the same because, again, yields are being increased. So you've got this double whammy going on, and add to it, well, maybe I'll just say that yields roughly would have gone from 3.5% to 4.5%, which takes a lot of people out of the money. There's a lot of people that had come in made their investments, and now those ones are stuck or in trouble. So on top of that, you've had this condo market that was just booming. There was a lot of product coming into the market. All of those end unit buyers couldn't afford or can't afford to sit on those units, so they'll let them go at almost any number. So that's put pressure on apartment rent. So $100, $200, $300 a month. Like we're really seeing things change. Vacancy up a little bit, rents coming down a little bit. Now you're kind of going, I think the good news is we're getting to the end of this. Like we're into a period now where there's nothing new that nobody can afford to build again. So we'll finish all this product, probably 2 years at least of still inventory coming in. But then we're going to get a period where it's just comfortable. It's going to be better. You're going to see rents doing this again. So the positivity is there, but it's just a matter of when do you want to put your stake in the ground and start buying apartment buildings again. So some groups are smart enough to say, let's do it now. I think we're at the front end of a change that's coming again, going into 2026. As rates come down, the math is going to start to make sense again. Money's going to come in. And if you don't want to be in a lineup of 10 to 20 bidders again, you got to buy now. Like it really feels like this is the time.
18 months ago, there's a lot of people talking about dry powder. Dry powder was the hot phrase, and it felt like there was sort of these haves and have-nots, and there's a lot of people sitting on assets that they'd probably like to dispose of, but couldn't rationalize the price. With interest rates coming down, do you think that kind of like releases the valve, so to speak, where there's a lot of people that just need to recapitalize and get out,
Absolutely.
and it gets them to price, and that. I think that's probably true across most asset classes.
I look at all the public companies who have IFRS issues. You look at the open funds who have redemptions and or just book value issues. So the book to market gap's going to change. There's a lot of product that can come in. It's just going to be, is the equity there? I think the biggest thing behind the scenes right now is institutional capital has retrenched. It's gone into things like infrastructure, other options. So now it's going to be levered returns will start to look better. That's going to draw money back. The real question is, when does it happen? One of the other shifts that people don't talk about is a lot of the bigger pension funds now they're being led by private equity people. Once upon a time, it was always real estate people. So we now have to fight harder to tell the real estate story to somebody who does this looking at real estate and, is kind of go, convince me. GP math is changing. All the governance for how to invest, it's changing. There's going to be new rights that are asked for. So the game is changing, and it's going to be something where the best of the best fund operators or public companies, like the best of the best are always going to do well, but there's going to be others that will have a real tough time in what's going to be happening going forward.
Peter, how does like sustainability and the whole ESG framework play into this? Like, that was a hot topic. We talked about it so much in 4 or 5 years ago. It kind of seems to have just disappeared. And I know it's still there. I for sure it has to be percolating. Like it has to be coming forward at some point. I know, and of course, our large institutions, they've always got it as part of their mandate, but it seems to not really have had any major impact on decision making yet. Is it when is it coming? Like is it still too early? Like what's that horizon look like?
It's just something where in, let's say, 2014 to 2020, the industry is making enough money, things were positive. You could go into that direction more. You could make that a focal point. Now it's all about just trying to survive, trying to make some money. You're trying to work on your operations. So it's there, but it's in terms of priorities, it's gone from of the top to somewhere middle to bottom, only because there's other things that have to take priority right now.
You mentioned asset cycling as part of the plan right now, because we are at a pivot point in a number of asset classes. And it's tough to, of course, pinpoint, a one overarching strategy to, diversify a group of investors. But the conversations you're having right now, where do you see the pivots coming? What do you think people will be doing over the next kind of 2 years?
Well, I think everybody's just going to get more and more comfortable again with real estate as an asset class. So I think as you go through and you start to have quarter like MSCI prints where returns are picking up, when you start to see public company share prices increasing, it's going to be a natural magnet for capital. Capital's always looking for where it can make some money, where it can be the most efficient. I think we're at that stage where, again, you've got to watch real estate. Nothing being built is going to make the fundamentals better. Fundamentals, as they improve, attract capital. So just that in and of itself, I'm excited about. And then add in, probably 3 or 4 rate cuts. It'll be led by the U.S. we're going to go in a much more positive direction. I mean, the reality is in Canada, for 10 years, we didn't have an economic policy. It was all social policy. Now we're going to get into something where it matters again. We've got to drive productivity. So when you pay the level of taxes we do, it's tricky. When the Canadian dollar's worth, 72, it's tricky. So we need to enhance our thinking, our approach, just so there's more. There's more for all Canadians. There's more for the real estate industry. And I'm hoping the new leadership in our country just looks like we're going in a much better direction. So I'm optimistic at this time. And I think from around the world, what I hear about Canada is we had this 10-year period. We're now going to go in a much better and predictable direction.
For heaven's sakes, I mean, the guy ran the Bank of Canada, then the Bank of England. Like, you must have a good sense of how this stuff all works, right?
I really hope so. And being able to build, the global relationships, just to be able to get along with people, to be able to do things where it's a win-win for everybody. Like our business, it's strictly about making win-wins. Like it's never win-lose, because that's such a short-term way to think about things. I think the existing leadership gets it. Like it's a much more realistic approach.
It's a slow, long-term game, right? It's not knee-jerk. Yeah. Well, to be determined. It's only been 8 months he's been in office, so let's just cross your fingers.
And we got to give him a plug.
Yeah. There you go. I don't care what color his tie is, right? As long as he makes the right decisions, smart decisions.
So Peter, one of the things we talked about with you before you go, and Aaron kind of alluded it to in the intro, your position in the market. It is that 60,000 foot kind of global view of real estate that, a lot of us don't get. A lot of us get kind of stuck in the trenches and, hey, like I specialize in, Ajax Industrial and that's it. You're operating at a different kind of level. You interact with players right around the world. What are you seeing from places, as far away as Asia, which would be another, major potential investment in Canada? Yeah,
certainly a big shift in our business where once upon a time, a lot of our trading was China. With just some of the changes there, it's pivoted to Singapore, Japan, Australia. Those are the bigger markets for us right now. When I look at the new money, like all of a sudden we're seeing some Australian inbound activity. We've got the government of Singapore that we introduced for the Take Private Summit once upon a time, maybe about 3 years ago now. All of a sudden, those kind of players are coming back. We're seeing more of them. And what do they really like? It's that positive leverage. If you go to buy an apartment building in the U.S. right now, you might buy it at a 6, finance at a 7. Here, you're buying it at a 5, financing at a 4, and that positive leverage is attracting more money. But the overbuild in China has created a lot of problems, so there's less money coming from there. But the Japanese, Singaporean, the Australians, we're going to feel more of that. We're going to see more of that. I've got an upcoming trip, Hong Kong, Tokyo, Singapore, Seoul, where we see the biggest investors. And there's the way that we sit down just to help them write white papers on Canada, just to be able to understand how to come in, what to do, what are the returns like. Again, this might be Canada's time just to be different. I don't need more U.S. right now with everything going on. Let's have a bet close by. And I'm feeling that interest. It's not only Asia, but Europeans as well. Like there's a lot of reason why Europeans would look at us the same way and want to be in Canada. So we'll see. I mean, we've gone, again, through a really tough period, really globally. So 5 years of tough times in real estate. I just think I'm used to every decade understanding 1 or 2 years will be tough. We've had 5. There has to be now this next leg up. It's just a matter of when. And I'm thinking it's 2026 is when we're going to see it happen.
I make this joke, but it's like news flash, like real estate is cyclical. Like right. So,
but this time it'll be different.
Yeah. We had 18 years of no cycle, so it was bound to happen. Yeah, and I hope you're right. It feels optimistic. I think the vibe, we were at Real REIT yesterday. That was the vibe here at CAIC. It feels like everyone has this sort of pep in their step. Like I can see the light at the end of the tunnel. And certainly Benjamin Tall standing on stage saying we're going to get rate cuts in the next week is music to everybody's ears.
That's going to be the psychological shift for everyone, because it was that rate shift in the wrong direction. So in all that central bank liquidity that came into the markets drove inflation, and somehow we were surprised that rates spiked. I mean, just this downturn, these 5 years, it's been more government led than it's been us. Like as an industry, we haven't overbuilt, we haven't done things you shouldn't do. So we're now reacting to missteps and oversteps. And just if you leave us alone as an industry, there's some really smart, really thoughtful people doing great things. I think it's a great place to invest money. It's a great place just to work, live, and be a part of.
I feel better about my job now. I like this. That's the messaging's great. Peter, it's great to have you on again. Look forward to having you on for a fourth visit. We get you a soft commitment now. That would be great. We've really enjoyed our time here at the Canadian Apartment Investment Conference, and we of course do thank the Real Estate Forums for putting together this interview with Peter. Peter, thanks for spending time with us.
Great to see you both. I love what you do.
too.
Congratulations on all the success that you've had, and thank you, First National.